Good afternoon. Good afternoon, everyone. Mixed bag for the market today. Chairman Powell just got finished speaking and at his press conference, and some interesting commentary there. Nothing really shocking, nothing unusual, nothing that I didn't expect. Pretty much a lot of the same, essentially backing up the policies that they have put forward, backing up and promising without actually promising and saying those words, but promising lower rates for longer. So markets don't like it. The Dow didn't like what it heard. The Nasdaq Composite loved what it heard, and there are the two races, the two horses running a different race, and there's maybe some reason for that. But for the most part, the industrials were a little bit heavy most of the day, and the NASDAQ was a little brighter. But at the end of the day, we'll see how they both fare. As we speak, the Dow is heading down, and the NASDAQ is holding up fairly close to its highs of the days. But the whole prospect of the Federal Reserve coming out and saying anything different or unexpected, and certainly in their two-day meeting, discussing anything that they would have to report to the country that would be problematic for the economy, problematic for the markets, was just never going to happen. So it's not a big deal. There were some pretty good and tough questions asked of Chairman Powell in terms of did he see the markets being frothy? My terms, not his, not the questioner's comment, but he was asked that a couple different times, couple different ways, and bobbed and weaved brilliantly, as most Fed officials are adept at doing. The bottom line there is he's not going to say that he thinks that markets are frothy. He's not going to say that the Fed has done too much and there is no honest transparency price. He did talk about markets finding proper levels. My words, not his, but that's not happening, and he knows that's not happening. So a lot of hogwash in there, which is typical of some of these conferences, or pressers. Nonetheless, nothing unusual. we know what's going on. Fed's going to keep rates lower for longer. It's going to continue to monetize the Treasury's debt, and all of that's going to be good because there's nothing they can do to pull back. If they pull back now, as the economy is sinking into its lows, which will hopefully be this quarter, and probably, hopefully, we'll see a rebound in the third quarter. But we know we're going to sink into this quarter and probably hit the lows, the nadir of what may be the shortest recession on record. That's the hope. And if that's the case, the last thing the Federal Reserve Chairman is going to do is upend markets, which would immediately turn everything around. So he did a pretty good job. Nothing exciting there. I wish there was more to tell you there. So if you guys picked up anything that you want to talk about, anything that you think was unusual or extraordinary or promising or perhaps a negative, bring it up. Let's talk about it. For my part, whole lot of nothing. And some of you know this, maybe most of you don't. I don't believe the Federal Reserve should even exist. I think there are much better ways to conduct monetary policy. I don't think it should be actually a policy. It should be a formula. You want to expand the money supply as the economy is growing, you do that because you need to expand capital for everyone to have capital assets to grow. If the economy is shrinking and you don't want to necessarily pull in money, you want to make a little more available, you have a formula where you can do that too. There are plenty of formulas out there that have been offered up to replace the Federal Reserve, and you don't have the politicization of deficits, which we have, and we don't have a lot of other inconsistencies, and we certainly don't have the tamping down, if you don't mind that kind expression. I would like to rather call it the bastardization of the capital markets in this country. They have been absolutely destroyed by the Federal Reserve, and we don't have free markets. That's good for a while because asset prices get inflated. We have these wonderful bubbles. If you get to ride them, you're on the right side. It's just all well and good until it isn't. And the reason we have crashes is because we have bubbles. The reason we have both is the Federal Reserve, the manipulation of interest rates. If we didn't have that, then what we would have a sound economic background, and we would have price transparency, price discovery in our capital markets. We'd have proper allocation of capital. And the way to do all that is get rid of the Federal Reserve. And the only reason that we need a Federal Reserve is to save the big banks when they blow themselves up. So that's the purpose of the Federal Reserve. That's what it does. If you slap a 25% reserve requirement on all of the banks, we wouldn't even need a Fed. They wouldn't be able to blow themselves up. All right. They would make their money lending it out, lending depositors money out, borrowing short, lending long, and they would keep very tight, probably close to matched books. None of that has happened for decades because the Federal Reserve is there to bail the big banks out. They don't bail all the banks out. They bail out the ones that are too big to fail, because those are the ones that have influence, if not equity, in the Federal Reserve. All right, there's my little rant on the Federal Reserve. A couple questions here. Craig is asking, can Shah address the strategy of using leaps instead of covered calls as an income play? Craig, give me a little more specificity on that. I'm not sure how you want, if you have a strategy that you use, you want me to address as far as leaps and income. I've never used leaps as an income play, but if there's something, the way you like to use them, I'll be happy to address that. Sergio is asking, love to get your opinion on WATT, W-A-T-T. What? So we'll take a look at that. So couldn't help that. That was the easy one. WATT, symbol W-A-T-T, and that is Energis Corporation. And I don't know this one. It's trading $2.43, Sergio. So I'm just looking at the chart, and obviously it was going downhill pretty steeply. I'll go back a couple of months. Let me go back a couple of years, see what the trend is. The trend has been down since 2018, pretty sloppy, had a crazy run up, and then just slid from there on until we get to some pretty crazy action all of a sudden. So this stock gapped up, and it has pretty much very thin volume other than when it's making these crazy moves, and it seems to all of a sudden attract a lot of attention. So I don't know what the company does, Sergio. It just looks pretty crazy. I'm going to have a quick look at on Yahoo. It looks a little dangerous to me, but we'll see what actually it does, and if we can get any metrics on it and enlighten everyone as to what the company does. Heading into the close, we got about almost a little shy of 6 minutes left. Markets are pretty much holding where they were when we first started up. Not a lot of nothing really right now. A little slow on my internet, nothing new there. Okay, just going to give this a quick rundown. This is a really small company. It's a $98 million market cap, so tells you a lot right there. So obviously a little micro cap, negative numbers all the way down, negative return on assets, and that, just revenue 195,000. It lost 35 million on that. So that says everything you need to know. Operating cash flow, negative 26 million, levered free, negative 12 million. It's got a short position in of about 13%. So you're going to see those kinds of spikes. It just looks like a crazy company to me, not something that I would apply my capital to. And you see these kind of moves. It's down 23% today, and after this that just crazy move up, the company does. It's a wire-free charging solutions. Okay, sounds pretty cool, but not very big and apparently not very successful because it's not making any money. The company develops a watt-up wireless power technology, consists of semiconductor chipsets, et cetera, et cetera. Looks like a tough company to invest in long term. I'd steer clear of it. If you're in it, be careful. Hopefully that helps, Sergio. Len's asking, what do you do with 11521 HTZ puts? The Hertz is just crazy, everybody. If you're not aware of it, Hertz, which declared bankruptcy 2 weeks ago, has been trading like it is Apple. It's just, there's so much interest in it. It's mostly retail. And we know that because if you look at some of the metrics on the discount brokerages, and Robinhood is one that puts out a lot of metrics on what its customers are trading. Hertz is up there, and it's just, again, to repeat, this company declared bankruptcy. Are they going to come out of bankruptcy? Are people bidding up the stock because they think that the company comes out of bankruptcy? The equity will rise and you'll have a windfall, because this, after all, is a company that's been around for more than 100 years and should perhaps be deserved of being saved. And none of that really matters. I don't get it. The market cap based on the price now is about $360 million. And generally in a bankruptcy, for all of those folks who trade this thing, and it's trading wildly right now, even as we speak, it's down 30, 49, 40%, is that the lenders take over the assets and they decide whether or not they want to restructure. And if they do, they want to take all the equity, because they're the ones that have put up all the money, lent the company money through different types of transaction. And some of the transactions that Hertz set up are pretty crazy. And the lenders there are going to want to take the equity for themselves because they get nothing else. They're going to take the cars, the assets, they're going to try and sell those. Maybe they'll resurrect the company out of bankruptcy and see what they can make out of it. But it's going to be a tough slog if the marketplace, the environment, the economy we're in right now stays somewhat like it is now, where people aren't running around traveling. Travel leisure side of the whole equation is still completely upended. And if you're trying to put money into a failing rental car company when there's tons of really tough competition out there in a very overcrowded field, you might want to think twice about that. So the fact that anybody thinks that they're going to, this equity, the $2.53 equity, which is what the value of a share is now, not the value, but the price, that's a tough slog. So I don't know. It's long-winded. With the $1 puts, you got, what's the date on them? I didn't see what expiration you had. If you've sold them, then you don't have to worry. If you bought them, obviously you're not making any money, but you got time. I'm not sure what your expiration was on those. So it's just a crazy situation on Hertz, and I don't understand. I wouldn't be playing it. It's just, I guess it's a fun game, and if you think you're going to win, you can. And by the way, you can just make money trading it. You don't have to be holding on to it thinking it's going to be worth something. You could simply buy Hertz thinking there are other fools out there that are going to bid it up, and you can sell to them at a higher price. Yeah, that's called trading 101. Do it. That a long-term value in the stock, I don't see it. David Lee, following up on a couple thoughts. A couple weeks ago, I shorted DPZ and it's worked against me. What are your thoughts now? All right, DPZ. Domino's has been a lot stronger. I think it's just got to a point where the company is overvalued. The stock is certainly overvalued, in my opinion. It's riding the wave, obviously, of the lockdown, and the company did very well there. So it's got that boost. But to me, I don't think it's got a whole lot more to go. Granted, it's done very well, better than I expected. Um, I would be inclined to hold on to any position here, looking for this stock to take a breath and come back in. If the market continues, a little weaker, and we're coming into the close on the weak side, at least as far as the Dow and the S&P goes, at some point, I think this rally has been a little bit, if not a lot, overdone. And I think the market is going to come in a little bit. There's going to be some profit taking. And Domino's, I think, is going to be one of those stocks that's going to be some profit taking because it's just gone too far too fast. Makes sense. The narrative is there, but not the valuation. It's not justified. Um, so yeah, David, I would stick with it for a little while longer. I think you maybe got a couple weeks, maybe 2 weeks, and I think this is going to looks like it may roll over. If the market continues higher, no, then I think it'll just get bid up with everything else because that's the way everyone is looking at the market. Just grab onto something and ride it up. John's asking, oh, okay, FIVN. This is a tough one because this company loses money. This is Five9 Inc. Everyone, symbol FIVN. It's a tough one because it's one of those stay-at-home, work-from-home type stocks that makes a lot of sense. And however, to me, it's not one of my favorite companies for sure. And I'm not sure. If you own it, enjoy the ride. It's plain and simple. But I've been looking at it for a little while now, and actually wouldn't mind buying it lower, but it doesn't seem to want to come down. It just seems to me overpriced for what it is. And again, it's had this tremendous coronavirus run, like a lot of stocks that fit the narrative of order in terms of Domino's, the kind of stuff that 8x8 does, or Citrix, or a lot of these companies that get put into that work from home type environment. What they do, their software, hardware, a lot of that stuff. A lot of these companies have done well, and surprisingly, it's surprising to me that they wouldn't have come down a little bit more. This company has. It's just got a small loss of $10 million. It doesn't have huge revenue, $348 million. So it's not one of these companies to me that I'm excited about because it's got huge revenue, and I think it can increase its margins. I think it can do all kinds of things because the margins are terrible. Profit margins are negative here. And that's another reason I'm just waiting for the company to do something that justifies the price of the stock up here. So I'm not a huge fan of it. I get why it's going up, but to me, it's unjustified. The price is too high. Another reason is there's typically 5 to 10% short ratio in there of stock, of floating stock, and that's always ammunition for the upside. So if you own it, just enjoy it. Again, anytime you guys own something, it doesn't matter what I think about it. It doesn't matter. As long as it's going in the direction you want it to go in, it's a good stock. It's a good play because it's working for you. Sometimes we overanalyze things and it's not worth it because if you're making money, that's all the thing you need to analyze, how much money you're making. And if you're continuing to make money with it, then you continue to ride it. Just be careful and don't be greedy, and don't take your profits. This kind of rolled over a little bit here. It's popped back up. It's up nice, almost 5.25% today. And you got some problems. If this stock gets down, it's got some support, but it also looks kind of weak. If it gets to 90, this stock to me could tumble a good bit. I think it's got to hang up around here. It's got to probably stay above 95. Below 95, I think I'd get a little worried. If it gets to 90, I'd be real worried. If it breaks 90, and I had a long run in, I would certainly be out before then. But I'm a little apprehensive about the valuation on that. So yeah, so to answer your question, John, I wouldn't buy it right now. It's yes, it's done well. It's kind of rolled over a little bit. I would not buy it in here. I know this sounds crazy, but if it gets back to say 105, it looks like it's strengthening and the market's strengthening, then maybe, but then a very tight stop because this stock is trying to level out, maybe trying to consolidate all the gains it's had, and maybe weakening because again, between 90 below 95, be careful. Below 90, it could break down. Hi, Shah. When you look over stocks, do you look at volume? No, I used to. Volume doesn't mean nearly as much as it used to. Well, it doesn't make really not much at all these days because there's so much noise in the volume. There's so much high frequency trading, so much turnover, so much just generally speaking, there's not good information in the volume anymore. The volume used to be more indicative of big traders, of institutions, of real money moving in. Now the money comes from every which way. It comes in, it comes out. There's so much trading in the day, it can affect the volume. The only thing I do look at over some period of time is I look to see if a stock or the market is rising on increasing volume on days when the stock is up or when the market is up. I like to see that. That's a positive. And if on days when the market's down and or the stocks we're watching are down and the volume is down on down days, that's a positive too. It means that there's more commitment to stocks on the way up. More commitment, buyers are more committed than sellers. Excuse me. And that's a positive sign. We have been seeing that for weeks now in the U.S. markets. Weeks. On just the latest example, Friday to the big day Friday, we had big up day, we had Friday, and then yesterday we had a down day. So from Friday to yesterday, the volume dropped was 38%, 28% lower yesterday than what it was on the up day Friday. It was Monday we had an up day. Okay, nice follow through day Monday based on the nice rise we had last week. Monday, bang, more momentum. The volume was very nice, very robust. It wasn't quite as big as it was on Friday, but robust. And then of course yesterday we had the sell off. Guess what? Volume from Monday to Tuesday was down 10%. So we're seeing a lot less volume on down days, and that is to me encouraging, an encouraging sign in spite of some of the irrational exuberance I see in the market, that there is still some upside left in the market. That's one of the most encouraging pieces. So I look at volume on in the big picture, stuff like that. A lot of times during the day, intraday, day to day, it's just a lot of noise. If you want to get a kind of 30,000 foot perspective on it, then I use it for that kind of just what is the trend? Is the trend being confirmed? Hopefully that helps you. Jay's asking, do you think airlines are headed up or down in the next week? I don't want to be flippant, but I would say they're probably going to do both. Here's the thing: we've talked about the airlines many times and the cruise lines, and we talked about retail investors. We talked about bottom fishing. This is all the narrative, if you will, when it comes to the airline stocks. That's exactly what it is. And here's American Airlines down again, 7.5%. Let's take jets. We talked about jets, obviously. Jets had a real nice run up, and it's having a big, tank down again. So it's down 7% again today. So again, this is what's happening. Retail rushing in, rushing out. And we're going to continue to see that. So I don't see the airlines until I see airline traffic pick up demonstrably, then I'd be inclined to be very cautious on the airlines. At some point, I think they're going to be a great buy. The question is really which one? All of them? And or what could happen if there is no traffic? The pickup in traffic doesn't sustain their solvency, then you're going to have issues and they're going to have to be rescued. And I'm not talking about another 25 billion. I'm talking about a lot more. They're all hurting. So yeah, it's to me that it's great trading stocks. You want to play them up, play them down, trade them. Are they a long-term hold right now? I just don't see it yet. At some point, yeah. Let me extrapolate just a little bit on that. For me, I'd be willing to take a position, a longer term, look for a longer term hold position in them if they tumbled back down to their lows. All right. If they tumble down to the lows, then I would say, let's see what's going on. If they tumble down to the lows simply because the market's tumbling and knocks them all down, because retail investors are exiting because there's some little retail panic and these stocks get hit, then I might start to look at them. As long as the economy continues to heal, as long as traffic looks like it's increasing, then I would look for some position lower. Otherwise, right now, they're just trading vehicles, and that's partly because of the retail action in and out of them. So be careful on them, but you can trade and swing trade them. And, it's the kind of stock you can take a morning position in, and if you're right, you can end up in the afternoon with a nice bit of profit. So the problem is a lot of these stocks are gapping down. They're gapping up. So the move that happens is pre-market. In other words, by the time they open the stock up, it's up 3, 4, 5, 10, 12, 15%, or it's down 7% on a gap or 10% on a gap, or it can be down 20% on a gap. And of course, if you're holding that position in the wrong side overnight, you're slammed. So they're dangerous to play right now. So hope that helps you, Jay. Peter's asking, Rada, defense stock, up 13% today. My one good winner. I'm glad you had one good winner. I've had days when I've had none. I've had bad luck streak in dancing school kind of streaks, as I call them, where you just can't buy a thrill. And then, stuff happens, it breaks. Next thing you know, I'm on a tear. But it's trading. And if you do a lot of it for as long as I have, it comes with the territory. So one good stock today is good. Up 14.25%. Wow, it's a heck of a nice gap open there today. Good for you. Congratulations. Hopefully it continues to go. It looks pretty good. I'm always a little cautious about gaps, but that looks pretty nice and had a pretty good run. Looks like it wants to break out to new highs, and I hope it does for you. Tom's asking, DGLY, mixed body cams. Yeah, those stocks, you would think they would do really well. And GGLY through the roof. It's obviously taken a bit of a hit today. But again, if you look at this digital ally symbol DGLY, it was absolutely going nowhere, just dead in the water. And all of a sudden, news, the narrative, cameras, okay, everybody thinks the police should have cameras and everyone should have cameras, and cameras, and therefore you see the stock go up. The question really is this company going to, just based on the stock price and the action of the stock, doesn't look that healthy. I don't know the company. I have a quick look at it. If you own it, if you played it because it's a camera play, then you're smart. Right? That's a good move. It's down more in the after hours. But it's a small cap stock, 57 million market cap, loses money, ridiculous negative profit margin. It loses $10 million a year. It's got negative cash flow. It's got $6 million in debt. Frankly, it's garbage. Is it getting a short-term run because it's in the business of selling cameras? Yes. Is it more than that? I don't think it's much more than that. There are a lot of bigger companies that will be able to fulfill any kind of orders, and this company is probably not one of them. So I wish them well. I like to see companies succeed, but this one, as far as the stock and the equity, that's a dicey proposition. So if you made some money on it, good luck with it. Hopefully that helps you, Tom. I think if you want to get into a camera play, there's better companies out there for sure. Peter's asking, with Hertz going belly up, how about Avis? All the car companies are obviously in trouble because of that. The business they're in, travel and leisure business, it was the worst hit really of all the sectors in the economy. Avis it's got its struggles. It's got a tremendous amount of debt. It's a survivor right now, but got just a massive. I got $18.25 billion in debt. It's only got 679 million in the bank, and that's probably a lot of that is probably gone already. So they pulled all the revolvers. I'm sure all these companies have gone to market if they could in the debt market trying to raise some money. They've all pulled their revolvers and taken down whatever they could on them. It's a survivor right now. And as a play, let's have a quick look at the stock graph. Had a nice run up, as Hertz was going down. This was going up. Had a real nice bounce. This is that bounce off the bottom. Is the economy opening up? Now it's rolling over. I'd be careful about it. It's just it's not a sector that you can be confident in taking a long-term position and applying a lot of capital and sitting back and sleeping well at night. Just be careful. Sufi, I still haven't heard back from my friend on the cannabis stocks. I'm doing a little more homework on the 5G, and I know I owe everyone some dividend stocks. I got a few names, but I got a long list. I'm trying to go through the list, try and find the ones I really like. But still working on those for you. I have not forgotten, and I apologize. Thanks for your patience, Sufi. Craig, I bought a January 2002 Leaps contract, and I'm selling monthly calls for the rest of the year. Okay, that works. Yep, yeah, that absolutely works. What do you buy it on? A January 2002 Leaps. I'm not sure what that is. January 2002 Leaps contract, and I'm selling monthly calls. I get the fact that you bought the Leaps and you're selling calls against it for income. That works, but I'm not sure what the 2002 is. January 2002, 2020. Well, we're past there too, so I'm not sure what the Jan 2002 means, Craig. Anthony, STZ, run too high to buy? Let's take a look. No, I don't think so. I like Constellation Brands. I think it's a great company. It's a well-run company. It's had a very nice bounce, and I think that the stock action looks very positive. Let me have a quick look at some of its metrics. And I know they carry a lot of debt. It's the only thing that would concern me, but it's a function really of liquor sales and their revenues and their ability to continue to service their debt. So let's have a quick look where we're at. Huge revenue, $8.34 billion. They are losing some money. They're losing annualized $11 million loss right now, sitting on pretty slim pickings in terms of cash, 81 million, total debt 12.75 billion. And considering they're losing money, they must be borrowing to continue to pay their dividends. So I'd be a little concerned about that. Their cash flow and levered free cash flow looks pretty good, but the debt load is pretty severe. I like the company. I'd be a little concerned about it with that debt load and the fact that they're losing money now. I don't know. I mean, that must be because obviously so many restaurants and bars have closed down. Liquor sales have just fallen off a ledge. And if they're opening, they're coming back, then obviously the revenue will pick up and things will be fine. Sorry about that. I mean, I like the company. If you own it here, or you're thinking about buying it, I would just be concerned. It's a long way down, but 165, there's support there. If you buy it in here, I think you're okay. But again, This market is getting heavy. There's a lot of irrational exuberance, and it would not surprise me to see some profit taking because there hasn't been any yet. It's been so minor that that's not typical of a run up like this. Okay, Tommy, FIVN has 101% stocks held by institutions. How can it be over 100%? Great question. A very simple answer: short sellers. So if you look at that and you say, okay, how can the held by institutions be more than 100%? It can be sometimes if you really come across some of these stocks that are heavily shorted, it can be 110, 115. I've seen 120%. So how can institutions own 120% of a stock? Obviously, they don't. That's just indicative of extra stock that's been borrowed in order to get shorted. So anytime you see that, take a look at the short ratio, the short interest, and you're going to see a high short position. That's how that goes. That goes hand in hand. It's just as simple as that. So you can't create more shares. The only way you create more shares in terms of holdings is if you manufacture those shares artificially, which is meaning borrow them. So there's 100% of shares, and let's say they're in a cage somewhere, and I borrow 5% of them. Okay, you might say that's now I'm an institution, I'm shorting it. You could say, well, this institution owns 100% of the stock here, and then there's another institution that owns 5%. Well, I've just borrowed it. Why did I borrow it? The only reason I would borrow it is because I want to short the stock, and I need to borrow it. I need to locate the stock, borrow the stock before I can short it. The reason I have to borrow it is because the person who's buying it from me wants to receive their shares, and I have to be able to deliver them. It always happens in the back office. That's how it works, but you have to be able to deliver those shares that you sell. So that hopefully answers your questions. Don's asking about MVIS. Microvision, buck 19. Looks like one of the stocks we just took a look at, Don. It's obviously, in a day like this, it's going to have big volume, but the stock's doing a whole lot of nothing, going sideways, and really probably doesn't make much money. And all of a sudden it's doing something that someone's, some investors, traders are interested in. Stuff gets out on a chat room, stuff gets out there, and next thing you know, everyone's trying to make money on a cheap stock. And obviously it's had a pretty big move. If you went from 25 cents to $1.25, you've had a heck of a run in a very short period of time. So this is what generates interest in a company like this. Let's take a look at MBIS really quickly. I generally, not generally, I don't trade ever these kinds of stocks, even though I get a lot of calls, recommendations, get into conversations with folks. Oh, you should buy this. I'm in that. It's just not my cup of tea. This is a $145 million cap. Again, return on assets negative. Everything's negative. Revenue growth negative. EBITDA negative. Net income available to commons minus 23 million. It's got 2 million in cash. Got 1.9 million in debt. So nothing there. But it's got negative operating cash flow, negative levered free cash flow, and shares short. 14 million shares. So you got like about 10% short as a percent of the float. So there you see those big pops in a stock like that. Not my cup of tea. Don't know what they do. Good luck with it. Trade it to your heart's content and just take your profits because they may not last. Microvision develops Pico-P scanning technology to create high-resolution miniature projection and three-dimensional sensing and image capture solutions in the U.S. and Asia. Scanning technology includes microelectrical, mechanical systems, laser, diodes. Pretty cool stuff, but doesn't make any money, and it's a flyer. So if it's got a breakthrough product and they get a contract for something like that, or good luck to them, and good luck to you if you own the stock. Again, just be careful on stocks like that. good trading stocks. And sometimes just because they're not my cup of tea, you can make a lot of money on companies like these. Some of these companies will just be the future. They actually will become, they're like the next Apple. So yeah, just because I'm not interested in terms of a stock play doesn't mean the company isn't going to be a successful company. There's a big difference between looking at the stock and trading the stock and looking at the company because you like the product and you expect the company to continue to do what it does better than anybody else, grow into the marketplace, become the market, and become the next Apple. That they're out there for sure. So hopefully, if you own this, it's one of them. Pablo, you're very welcome. My pleasure. I know, but I need to know, based on your experience, markets should raise up a bit. To be a little more, could you elaborate a little bit more, Pablo? You say, I know, but I need to know, based on your experience, markets should raise up a bit, and with a question mark. So if you're asking me, do I think markets have higher to go? The answer is yes, they do have higher to go. For sure they do. But that doesn't mean just because the momentum is there, just because there's a lot of positives that are moving the market higher, including the fact that volume on up days has been great and volume on down days has been thin. Another positive. There's a lot of good stuff going on for the markets right now, but there's a lot of scary stuff going because you strip out all of the good stuff and you start to get in. It looks scary. You just have a handful of stocks leading the market higher, and then when you saw this attempted rotation, you see into the airline stocks. They go up, they through the roof, then they get slammed again. You see the financials go up, then they get hit. So you're having all of this kind of trepidation about going into the secondary stocks, going into the cyclical stocks. And if the economy was really solid, if we was a real robust, well-rounded, broad participation rally, you would see the cyclicals really start to move and consolidate. Every time they come down a little bit, they wouldn't come down that much because there'd be more buyers for them. There'd be more conviction, and we're not seeing that conviction. We are seeing the conviction in the companies that have always worked for good reason. The big mega cap tech giants have the earnings, they have the profits, they have the cash, they got everything. So they get the stocks prices bid up. That's natural and good and normal, and there's nothing wrong with it. But the rest of the market, there are problems. When you have such narrow leadership moving the benchmarks, and you have such, it's unusual to see this kind of retail participation, moving stocks, moving the markets. This time is different. So that worries me. I love the fact that retail investors are in. I love the fact that retail investors are riding the market higher, pushing it higher. If they continue to do that and the market then levels off, the economy comes back, and we just go leg up, leg up, leg up from there, then brilliant. And let's hope that happens, but it may not. So yes, it gets worrisome. Irrational exuberance doesn't mean it can't be it's not backed up. And this exuberance may be backed up. The optimism may be backed up by the economy coming out of this hole that it's in, and that would be good. So we in that case, we've got a lot higher to go, because there is nowhere else to go with your money. You're not going to go into fixed income. You're not going to make any money there. You're going to get beaten up trying to get in and out of the bond market. Who's going to lock in the rates that are so low that you're going to carry an interest rate of 0.8% for 10 years on the Treasury to do what with it? What? You can't go out to dinner on that. It's ridiculous. So no one's going to do that. That's why everyone's going into the market. It's that Tina. There is no alternative to equities. You can thank the Federal Reserve for that and their manipulation of interest rates. Chad's asked me if do I use clouds, Kimuchu clouds. No, I'm not really. No, I don't. I'm going to take a look into them though, but it's just something I don't use because I don't really know what they are. I'm not that familiar with them. I stick to some really basic stuff in terms of If you're talking about some technical analysis stuff, my technical analysis stuff is really thin. I've gone into a lot of different things, looked at a lot of things. Simple to me works. I like to keep it really simple. Eric is asking, in your opinion, what are the best resources to learn to trade options? There's some really good books out there. My favorite, well, it's because it was the one that I read way back, Options as a Strategic Investment by Macmillan. Absolutely fantastic book. It's, to me, the Bible. There are obviously newer books and probably a little easier to read. Go online and check them out. I'd take a look at them. But that one, Options as a Strategic Investment, was just, it's one of my favorite books, period, on the market. So great book. Old school, old stuff. Markets have changed good bit since then. But what is discussed in that book and how to look at options and how to price them, pretty valid. But again, there are a lot of good books out there. A lot of good books. So certainly you want to get into a couple of good books and read them. And what I'll tell you about options is keep it simple. Don't go overboard trying to create exotic spreads and get all caught up in having to lay off spreads against spreads and do stuff like that. Options are great for leverage. They're great for one-way bets. They're also great for controlling your risk. But they're also great for amplifying your risk too when you want to take a one-way bet and you want to leverage it. There's a lot of great things you can do with options. I don't go in deep the way I used to back in the 80s. It was a lot of options positions, and I learned. Took me a while to learn that simple is better. So when I simplified my options strategies, I started making a lot more money with a lot less aggravation. And I got to apply more capital into fewer positions, which when I was right, made a lot more money. So part of the problem with options that people have is if you get too complicated, putting on too many spreads, you're tying up a lot of capital sometimes, and you're still busy trying to create some risk reward parameters that you think are ideal. There's no such thing. They're just to your liking relative to your risk tolerance. And that's great, but you're tying up a lot of capital. I'm a conviction guy. If I see something that I think is going this direction, I want to make a bet on it doing that. And I want to make a streamlined bet because I'll make the most money doing it, or certainly a leverage bet, and I'll make more money doing it. And that's most of the time what I'll use options for. Pablo, I made 17% on APA, but I was at 33% at the end of Monday. Way too long. It happens. Timing is everything. And that's a good story, Pablo. Not that you didn't, it's not a good story that you didn't capture the full profit you liked, but you still made money. So that's a good story. But it's also a good story for everyone. When you got profits in a market like this, sometimes just take them. If you have a 33% profit in something, especially if you held it for a short while, that's a great profit. You get something like that in a couple of days. I'm going to take it. That being said, if you really like the direction of whatever the stock is doing or the market or the position you have and you think there's more juice in it, you can always take half the position off and let the other half run. And if you're right, good for you. If you're wrong, well, at least you got half of it off. And if the other half comes in and you end up flat on the whole position, you're not going to be happy. Nobody knows. No, there is no answer for that. To me, the answer is real simple. Don't be greedy. I'll say a million times, I've said it a million times, and I'll say it a million more. I don't care if I leave money on the table. I care that I make money. If I make 10%, I'm happy. If I make 100%, obviously I'm very happy. But if what I make 100% on goes to a 250% profit in 3 weeks from now, do I cry about that? Absolutely not. Absolutely, I don't care twice. I'm like, wow, that's a good move. Too bad I missed it. I've already got my money. I wish I had stayed in, but I didn't. So spilt milk, don't care. Move on. I've already looked for something else, put on another position, or looking to set up something else. And if I like that, I'll go back into that position. So again, I just like to ring the cash register because that way at night, I'm like, okay, I got some more money in my pocket. That's a good day. And that's sometimes what it amounts to. If you can bring the cash register on a regular basis, people are looking for grand slams all the time. You're looking to try and hit it out of the park. Good, that's great. But I'd much rather make 1, 2, 3, 5% a day, every day. Okay, because you're not, if you swing for the fences, sometimes you're going to make it, and other times you're going to strike out. So again, give me 5-10% days all day, every day, and I would never ask for more. That would be insanely profitable, to say the least. Okay, I got a couple more things, and going to wrap it up. We'll have a quick look at the market, see if there's any interesting resistance, or we know there's no resistance anywhere, but any interesting support position levels we're coming to. So real quick, got a couple questions. Got a lot of questions. Why, you guys? Sorry, I'm taking a little too long on the answers. My apologies. So I'm going to just move around real quick here. Jay's asking, did you give lists of target companies to consider shorting on the way to bankruptcy? No, not yet. Still culling that list. Again, when I'm looking at the market being still positive, I'm disinclined to want to put out a list of companies to sell or to short, because I know personally it's very easy to get caught up in that. And some of these bankruptcies, even though some of these companies look like they're heading towards bankruptcy and maybe should, a lot of them are going to get pulled up at the last minute. Some of them are going to get pulled up by the fact that they can sell bonds. They can go out in the bond market and they can save themselves. And the Fed made pretty clear today that they're still going to continue to do that because they know the companies need it. So that was part of the message we got today from the Fed. So that means some of the bankruptcies that you would think are looming may have a stay of execution for a while. We'll see. But yes, I will, at some point, I will give you a list. Tom is asking, you brought 5,000 at 170, sold at $55, covered calls at 193, credit out 70. Don't jinx it. Good luck. I like it. That's a good move. Peter's asking, NYT too close to top end? No, not just because something is high or close to its high or making new highs doesn't mean it's time to sell it. It doesn't. It's a little scary to jump in there, but if you own it, is it time to sell just because you made new highs and it's breaking out? Absolutely not. No, that's what you want to see. You want to see a stock break out. In fact, most stocks that break out have a lot further to go. Okay, this is a tough market, and some of these stocks, people are going to take profit if the market turns around. There's going to be a lot of profit taking at some point, perhaps very quickly. But as far as the New York Times go, I mean, this is a survivor. This company, everyone thought this company, the Times, was dead a couple of years ago, and this really made a heck of a comeback. So hats off to the NYT, to the New York Times. Yeah, I mean, again, I would continue to hold this if you hold it. It's broken out. It's probably got some more to go. I wouldn't sell, but I would certainly be mindful of my nice profits if you have. If you're nervous, maybe below 40, maybe look to take some profits. But then again, if the market continues to go higher and this stock looks like it's performing well, I would get back in. If you do get stopped out, or you take some profits of 40, I would get back in on a stock like this. I like stocks that are breaking out to the upside like that. So, but just be careful because, again, as great as everything is as solid as it looks, again, we just haven't seen any profit taking of any measure, and it's out there. Rohan, did you get a chance to look at GTN in regard to the election coming up? As far as Gray Television, I did take a quick look at it, Rohan, and it looks like it's a very well-run company. The metrics are pretty solid on that. I think it's well-rounded, and I'd like it. I think if you own it, I think you could be quite comfortable. It looks pretty solid to me. It's one of these stocks that flies under the radar, and you got some good volume though. But the PE it's a very inexpensive stock. The metrics are pretty good on it. I like pretty much everything I saw, and yeah, stay with it. GTN, everyone, Gray Television Inc., symbol GTN. Having a nice run off the bottom, and yeah, looks good. Solid company. Tom is that YouTube has a lot of info on options. Oh, good. Okay. All right. So if you guys are looking for options, there's a lot of stuff. Tom Gentile, who is a buddy of mine, he's an options master, and he owned the Optionetics company. I think he sold it. I think he might have bought it back. Tom is like me, goes way back, and Tom is a great teacher. So he also has some great services too. Picks some great stock. He's a great trader, and but he loves options maybe even more than I do. But he certainly plays them a lot, and I think he has some educational material out there. So go to the Money Mornings website and check out and look up Tom Gentile and see what kind of stuff he has to offer, because I'm pretty sure he's got some educational stuff there that's free. And if it's option stuff from Tom, you want to watch that for sure. Pablo, no more Tina. Then nothing but Tina. Tina all the way, Pablo. There is no alternative to equities. There isn't, as long as the Fed is going to keep rates this low, and that's the number one pillar under the market, under the equity market. That's it. That is it. And it's a gigantic one, because there's no limit to what the Fed is going to do to support the markets, the bond market first and foremost, and by extension, the stock market. So I have a couple more real quick. I think that's it. Let's have a quick look at the close. Just want to see where we end up and see if there's any. I don't think we're close to any levels that mean anything, but we'll just have a quick look and see. Dow closed down 282 points. That's down a little over 1%. We're below 27,000. It's 26,989. We got a high today of 27,355. So I had a nice robust day, and closed down towards the lower end of the trading range today. And again, there's a little bit of a gap there. On the downside, we got 26,780. We have some support there. And then below that, all the way down to 25,230. Now I need to do create some new metrics on this, because I haven't updated some of the stuff since we've broken through all of the resistance. So S&P had a down day also, down 17 points, or 0.5%, closing at 3,190. And the highs there was 3,223. And the lows, 3,181, had a narrower range there. As far as support on S&P, there really is no resistance on the S&P. Well, I guess there's we got some resistance at 3,259. So we got 3,259, which, on the high of the day today, we have 3,232. So it's very easy to get to that 3,259 level and break through that resistance. And then there is no upside. It's just the sky's the limit from there. Back down, we've got support at 3,013. So a ways to go on the downside. We do have some at 3,185. We got the low today as 3,181. So we got just below that support and then bounce a little bit higher. So we'll keep an eye on 3,185 tomorrow. NASDAQ Composite. What a surprise. Another nice day for the NASDAQ Composite, up 66.5 points, 0.67%, another winning day. 10,020.34. Just stunning to see the NASDAQ Composite over 10,000. Just that's stunning. There is no resistance for NASDAQ Composite. It's making it up as it goes higher. There isn't anything there. Sky's the limit. So downside, we have a low today of 9,962. We got nothing that of any merit down to 9,739. That's support down there. So got a lot of room to move up and down, but more room on the upside for sure for all the benchmarks. So there you go, everybody. Hope you all have a good day. I'm going to give you because you're all still here, I'm going to give you some dividend stocks. We're going to take a look at some more, but I'm going to talk about these a little bit more in depth tomorrow or Friday. These are just a handful of dividend yielding stocks, companies that I really like, and the reason is pretty simple. Besides the yield, their payout ratio and what they do and the money that they have to pay their dividends, I think is secure. So Verizon is one of them. I really like Verizon. I've liked Verizon for a long time. Dividend yield on Verizon is 4.24%. I think you've got upside in Verizon also. I just like Verizon. The cash flow generation is tremendous. So I'm not worried about that. The payout ratio on that dividend is 55%. Got no problems there. I like AT&T's huge dividend, but AT&T's got a lot more debt, and AT&T's borrowing to pay its dividend right now. SW, so Verizon, symbol VZ, dividend yield 4.24%, 4.25%. Next is the symbol, we talked about this, I believe, last week, SWM, Schweitzer Moduit International, symbol SWM. Dividend yield 5.49%. And I think my screen just stopped there because I'm getting a low resolution, but hopefully you guys are still hearing me. 60% payout on SWM. Dividend yield 5.5%, and a 60% payout ratio. Gotta love that. I'm going to give you one more, and we'll talk about these. Take a look at the charts on these tomorrow. Symbol E, and I'm trying to give you some fun ones too that's not so obvious. EBF. This is Ennis Inc. ENNIS Inc. Symbol EBF. Stock is at $18. Dividend yield 4.9%. Payout ratio 61%. And I think this stock has some room to go on the upside. It's consolidating nicely off of the bottom in a nice pattern, and it's getting ready to break out pretty much above where it is. I think above 1850 or so, 19. The stock could then get up to 22, make new highs. Anyway, just pretty good stuff. I got a few more. We'll talk about those tomorrow, but hopefully those three are for something for you guys to ponder, looking for yield. Have a great evening, everyone out there. Be safe. Sorry the screenshot froze, and I'll catch you tomorrow. Be safe out there.